What's up, hungry investors? Welcome back to the channel. Today we're diving deep into the Q3 2024 Boulder Group Net Lease Market Report to dissect the latest market trends and uncover opportunities in the ever-changing world of net lease investments. If you're looking to outsmart the market, maximize your returns, and make strategic power plays, stick around. Cap rates are climbing. Cap rates in the single tenant net lease sector have now risen for 10 consecutive quarters, reflecting a persistent shift in market dynamics. Here are the latest figures. Retail cap rates at 6.5% plus 3 basis points. Office cap rates 7.75%. Industrial cap rates 7.15, up 5 basis points. The driver, sustained high interest rates. With borrowing costs at elevated levels, sellers are being forced to reprice assets, while buyers are taking a cautious approach. What does this mean for investors? This rise in cap rates means lower valuations for sellers and higher yields for buyers. For those of you hunting opportunities, this could be the opening you've been waiting for. Here's why. Higher yield on investment. A rising cap rate environment translates to better returns for those who can deploy capital strategically, targeting assets where the tenant credit is strong and lease terms are long. Market selectivity as cap rates rise. Buyers have the leverage to be more selective. You're no longer competing in that frenzied, crazy investment environment of 2021. So take your time to conduct due diligence, particularly in markets or sectors that are showing some sort of distress. Supply is increasing. Supply in the net lease market grew by 6% this quarter, driven by several factors. Loan maturities, owners facing refinancing challenges who are offloading assets. Lease expiration. Properties with uncertain tenant renewals are hitting the market. Tenant concentration risks. Sellers are diversifying their portfolios by offloading risk-heavy properties. For developers, the game has shifted. They're building properties at higher yield on cost metrics, which could keep cap rates climbing, except in premium markets. The Federal Reserve's role. Let's talk monetary policy. The 50 basis point rate cut by the Federal Reserve has raised hopes of increased transaction velocity. Lower borrowing costs could lure sideline buyers back into the market. But let's be real, this does not happen overnight. Historically, there's a lag of a few quarters between a rate cut and significant changes in cap rates or transaction volume. 1031 exchange activity. The 1031 market remains sluggish, with experts estimating at least 2 to 3 quarters of heightened activity to absorb the current property supply. For investors, this delay is an opportunity to negotiate deals at favorable terms. Number 1, focus on tenant quality and lease duration. Invest in properties leased to tenants with strong credit ratings and industries resilient to economic downturns, such as medical offices, grocery-anchored retail, warehouses for last-mile logistics. Number 2, target distressed sellers. Sellers facing loan maturities or tenant issues may be open to price negotiation. Look for properties where you can add value through lease extensions or operational improvements. Number 3, consider secondary markets. While top-tier locations remain competitive, secondary and tertiary markets offer higher yields and less competition. Focus on regions with growing populations and diversified economies. Number 4, anticipate future rate movement. Keep an eye on the Fed's next move. If additional rate cuts happen, expect improved buyer demand by mid-2025. Position yourself now to benefit from these potential tailwinds. What to watch? Industrial properties. While cap rates are rising here, demand for logistics hubs near major cities remains strong. Look for deals where you can capitalize on tenant growth or e-commerce trend. The retail sector, we keep talking about it. Dollar stores, drugstores, and quick service restaurants are seeing the most significant cap rate expansions. Evaluate these assets carefully to ensure they align with your risk tolerance. So here are some of my final thoughts. We're in a unique moment in the net lease market. With rising cap rates, growing supply, and evolving buyer-seller dynamics, there's opportunities for those willing to adapt. So what's your next move? Are you stepping into the market to take advantage of those shifts? Or are you sitting tight waiting for the next rate cut? Let me know in the comments below. And if you want to dive deeper into the full report, head over to hungry-inc.com. You'll find all the data and insights to guide your strategy. Till next time, I'm Christian Cotta, and stay hungry, my friends.
You got to be hungry.